You ever driven on a brand new toll road or walked through some massive new airport and just stopped and thought, how on earth does something this huge actually get paid for? I mean, it's not just concrete and steel, it's this incredibly complex financial dance happening behind the scenes. All right, let's get into it. So here's the core of the problem: the sheer scale and timeline. When a private company signs a deal to build and operate, say, a bridge for the next 40 years, they are staring down 4 decades of almost impossible to predict uncertainty. And that creates a massive financial challenge that needs some seriously clever solutions. So, here's our roadmap for this explainer. First, we're going to break down the basic dilemma these huge projects face. Then, we'll look at the financial safety net they borrow from high finance and figure out how you even put a price on that promise. After that, we'll see how the deal gets balanced with something called a collar, see it all in action with a real bridge in Brazil, and then wrap it all up with the ultimate balancing act of risk and reward. All right, first things first. Why are these financial guarantees so absolutely critical to begin with? Well, it all comes down to one word: risk, and tons of it. For a private investor, a 40-year contract is just a total minefield. You've got demand risk. I mean, what if you build it and your traffic forecasts are completely off? Then there's construction risk, financial risks if interest rates go haywire, and maybe the scariest of them all, political risk. What happens if a new government gets elected and just decides to tear up the contract? Faced with that mountain of uncertainty, no private company in their right mind would sign on the dotted line. So you see, you can't just dump all that risk on the private partner. It would never work. The answer has to be a much, much smarter way of sharing that risk between the public and private sectors. The key isn't to get rid of the risk, but to give each piece of it to the party that's best able to actually manage it.
And that brings us to the toolkit they use. See, this is where it gets really cool. The solutions for these very real-world concrete and steel problems are actually borrowed directly from the super abstract world of high finance, using instruments you'd normally find on Wall Street. And the fundamental building blocks here are financial options. Now, there are two basic flavors. You've got a put option, which gives the owner the right, but not the obligation, to sell something at a price you've already agreed on. You can think of it like insurance against a price totally crashing. Then, on the other side, you have a call option. This gives you the right, but not the obligation, to buy something at a set price. This is great if you think the price is about to go to the moon. The key phrase here for both is right, not obligation. That flexibility is where all the value is.
Okay, so let's apply that. One of the most common tools you'll see in these mega projects is the Minimum Revenue Guarantee, or MRG. Basically, the government promises the private company, hey, if the money from this project drops below this floor that we've agreed on, don't worry, we'll step in and pay you the difference. It's a safety net. And this is a perfect example. An MRG is, for all intents and purposes, a put option on the project's revenue. Same exact logic.
Okay, so we get the structure, but that leads to the obvious, and I mean billion-dollar question for any government. What is the actual cost of one of these guarantees? How do you go from this nice, neat theory to a hard number you can actually put on a balance sheet? Well, the framework for doing this is called Real Options Analysis, or ROA. It's this really powerful technique that takes all the logic from pricing financial options and applies it to real tangible assets. Now, unlike traditional models that just spit out one single answer, ROA is designed to value flexibility, the ability to adapt as the future changes. It literally puts a price on being able to make choices down the road, which, as you can imagine, is absolutely crucial in these long-term projects.
Now, to actually do this valuation, analysts use some pretty sophisticated models. You've probably heard of the famous Black-Scholes model, but there's another one, the binomial tree method, that's a little easier to picture. Imagine a giant tree. It starts today with the expected revenue, and then it branches out into thousands of possible up or down scenarios for every single year of the contract. For every single one of those possible futures, the model calculates if the guarantee would have to pay out and how much. Then, it takes all those thousands of potential future payouts and pulls them all the way back to the present day to give you a single price tag for that guarantee right now. It's basically asking, what are all those future possibilities worth in today's dollars? Now, this leads to a really fascinating, almost backward-sounding point. I mean, normally in finance, volatility is bad, right? It's risk. But in options theory, higher volatility actually makes the guarantee more valuable. So why is that? Well, think about it. An option protects you from the downside, but lets you keep all of the upside. So the wilder the potential swings in revenue, both up and down, the more valuable that insurance against the downside becomes. But hold on, this is only half the story. A fair deal can't be a one-way street. It can't just be about protecting the private partner from losing money. What happens if the project is a massive runaway success? The public needs to get a piece of that action too. And this is where the other side of the coin comes in, the revenue cap. It's the perfect mirror image of an MRG. The private company agrees that if its revenues soar above a certain ceiling, it has to share a chunk of that extra profit back with the government. So financially, this is like the company selling a call option to the government. And when you put the two together, the MRG as the floor and the revenue cap as the ceiling, you create what's called a financial collar. It basically brackets the possible outcomes, limiting the risk for the investor while also capping their potential for a massive windfall. Okay, I know this has been a lot of theory, so let's make it real. Let's bring this whole thing down to earth and look at a case study to see how this structure works in the wild. And for that, we're heading to a huge project in Brazil, the Salvador Itabarica Bridge and Highway System. So to get this massive thing funded, the government laid out this super clear system for handling the revenue. And this table lays it all out perfectly. Look here. If the real traffic ends up being less than 80% of what they predicted, that's the low demand scenario, bam, the government's MRG kicks in. That's the put option in action. But if traffic is just booming more than 110% of the forecast, the company has to share 70% of that extra cash back with the government. That is the government's call option. And that sweet spot right in the middle between 80% and 110%, that's the target zone where everybody's happy and no extra payments are made. And that 80% number is so important. Think about what it means. It means revenue can fall a full 20% below what they forecasted, which is a huge shortfall, before the government has to pay a single dollar. This makes that risk threshold incredibly tangible for the investor. It's not some abstract idea anymore. It's a hard line in the sand. They know exactly how big their buffer is before that safety net kicks in. And when you look at it like this, it just becomes crystal clear. You can see the company's downside is capped right there at the bottom by the MRG. You've got that big win-win target zone in the middle, which is where everyone hopes the project lives. And then at the very top, you have the government getting its fair share of any unexpected massive profits. It's just a really elegant way to map out exactly who gets what and when. So when you step back and look at the whole picture, what's the big takeaway here? It's that these guarantees aren't just handouts. They are incredibly sophisticated financial tools, and they're designed to create this really delicate balancing act between public risk and private reward. At the end of the day, it all kind of boils down to this simple formula from the investor's perspective. They don't just look at the project's potential profit by itself. No, they take that number, they add the calculated value of that MRG put option they're getting, and then they subtract the value of that revenue sharing call option they're giving away. If that final number looks good and hits their target, well then, we've got a deal. This kind of financial wizardry is literally building our modern world. The bridges we cross, the roads we drive on. But it does leave you with one big question, doesn't it? As critics sometimes ask, are these incredibly complex deals always structured in a way that's truly fair for the public? Are we, the taxpayers, always getting that balance between risk and reward just right? It's definitely something we're thinking about.